All right. Good morning and good afternoon, everyone. It is December 11th, Thursday. Welcome to Morgan Stanley Asia Macro Webcast. My name is Crystal G, Asian EM Agri Strategist. Before we start today, please note that this event is for Morgan Stanley institutional clients and financial advisors only. It is not for members of the press. If you are a member of the press, please log off and reach out separately. Please also note that this session and your questions may be recorded. Today, we have Chetan Iyer, Chief Asia Economist, Kathleen Oh, Chief Korea and Taiwan Economist, Jenny Zheng, China Economist, Lawrence Tam, China Healthcare Analyst. During this session, you can send us questions at any time from the Ask the Question text box. First up, our Asian Economist team published a note on China's position in global manufacturing exports. We have Chetan today to share his takes on why they think China's share in global exports will still continue to rise in the context. Over to you, Chetan. Hey, Chetan, I think you are still on mute.
Yes, sorry about that. Hello, everyone. So we put out this deep dive report on the outlook of China's share in global manufacturing exports and the implication of that on rest of the region. So let me try and get my slide deck up so that I can share the charts while I go through the story. Right. I think the key call that we are making is that China's market share in global goods exports will continue to rise despite the concerns that we are seeing in form of increased protectionism. Also, a lot of the G20 economies are beginning to launch their own industrial policies to compete with China. We think that despite those challenges, China will continue to take its market share higher. It has been rising. If you look at it from 2019, there was a bit of a stalling in the post-COVID period. But we expect that resumption of rising trend going forward, and we expect share to go to 16.5% from 15% right now. In the bull case scenario, we think that it can go up to 18%. And there are two critical assumptions we are making in that scenario, i.e., that there will be less protectionism effort, and the competitors will probably not be as effective in having their own industrial policy work in a way that they can actually compete with China as effectively. So that would be the upside scenario. The sort of more like the bear case scenario would be that China maintains its market share around that 15% that it is right now. So even in that sort of bear case scenario, we think that at least China will be able to maintain its share and not decline. What are the reasons for this dominance? Number one is China now no more is just replicating the products which would have been innovated elsewhere in DMs. It's now at the forefront of innovation. China has lifted its R&D spending quite meaningfully over the last 5 years. And we also have the support from large amount of talent pool. And one metric that we look at for that is the share of STEM graduates in overall tertiary graduates outturn. And in China's case, that number is 41%, effectively highest in amongst the G20 economies. And we also see that the differentiated aspect of China's effort on this front is that China is thinking ahead of everybody else and then working on setting up an integrated supply chain for those products and areas which it has identified as the potential growth opportunities. The best example of that would be EVs. The seeds of EV industries development were sown in China 15 years back. So it's that advanced planning that makes a difference for China's presence in global manufacturing. The connected point in terms of making you appreciate the target that we are saying of 16.5%, whether it's achievable or not, is the chart here on the left-hand side. So what we did is to look at the top 15 fastest growing segments globally and within those segments, what is China's share? And you can see from this chart, it's still running at 18%, which is higher than its stock share of 15%. So as China continues to get more share in terms of its total exports of these high growth segments, its stock share will go up from 15 to 16.5%. And some of the segments, to give you the feel of which are the segments in which China is having outsized share, is the chart on the right hand side. Now, what does this mean for the competition in the region? So we think we would put the region into three buckets. Japan and Korea are going to see increased competitive pressures. Vietnam, Malaysia, and India will still see some increase in market share in global goods exports because they are the beneficiaries of supply chain diversification, which is taking place primarily because of the US policies. And the third group is the one which we think are unfortunately not able to capitalize on the supply chain diversification opportunity. And neither are they having any aggressive industrial policy for getting more directly a higher share in high growth segments that I mentioned earlier. Now let's look at the charts on these 3 points. So firstly, if you look at the chart here on the left hand side, the gain that China has had since December 17 in terms of its market share in global goods exports is 2.1%. And that has come from primarily Europe and Japan. So these have been the two big contributors for market share gain for China. And the reason for that is that the export basket that China has now has become more similar to that of the DMs. And Europe is the one where you can see the similarity index is quite high, which is it's at 47%. And in Japan's case as well, while it is lower than Europe, we've seen a significant rise in that export similarity basket. i.e., China is now directly competing with these DMs in the segments that they were traditionally big at. And for Japan and Europe both, the segments are automobiles and capital goods, which have been the key segments in which they have lost market share. And then just in terms of like the specific segments in which China has been able to get market share, I'll give you some examples here. EVs, its market share is now at 25%, whereas Japan is stuck at 5%. And we're seeing that Germany has seen an increase, but you don't have a parallel increase for some of the other European economies. And in case of lithium-ion batteries, again, the same thing. China's market share has gone up a lot. It's about 54% right now, whereas all the other DMs have seen a decline. And in case of industrial robots, it's another high-end segment for China. It is taking increasingly higher share. Now, this segment, the data that we get from is World Bank. We had to take construction machinery as a combined segment. But from what our industrials analysts are telling us, China's market share in industrial robots is actually 50%. In case of textiles and segments, so these are the low value-added segments. What we are also noticing is that China is not giving away market share in low value-added segments very easily. In some case, there has been minor loss, but it's not really that significant. So in that sense, it continues to lead in the existing sectors and then now has taken more market share in the emerging sectors. One aspect that we hear from some investors is that, because of the trade tensions, China is losing market share in the US market. But what we can see is that all what the US has been able to do is lengthen the supply chain And not only has China maintained its share, but it has actually increased its market share, right? So its presence in the global manufacturing supply chain is actually still continuing to rise. And the best way to explain this point is by looking at what has happened to China's trade surplus with the US, but at the same time, what has happened to China's trade balance with those economies which have taken that share from US from China in the US market. So on this chart on the left-hand side, on the blue line is a simpler one to understand. That's the trade balance that China runs with the US. It's now down $165 billion. But what China has been able to do is to more than offset that by increasing its trade surplus with the top 5 economies, which are getting more market share in the US marketplace. So that's an explanation of why we are not worried about the trade tensions and protectionism. We think China will still continue to take market share. With that, let me stop here and hand it over back to you, Crystal.
Thank you very much, Chetan. And then next up, we have some new progress from NDAA. And then today we have Lawrence to share the updates and then also implications on the Chinese CDMOs. Over to you, Lawrence.
Okay, thanks, Crystal. China also plays a pivotal role in the world's pharmaceutical supply chain. And if we go back just a few years ago to the years during COVID, its role was especially prominent. The Biden administration at the time put out a series of supply chain studies highlighting China's role in the generic supply space. So by one estimate, China supplies roughly 30% of the world's generic APIs by volume. And most of that goes to India. It gets formulated into drug formulations, and it gets shipped to the developed markets. And at the origin of this is China's APIs and intermediates. And the result of that study was to highlight the US's dependence on Chinese exports and to reshore or onshore US API production within the next 5 to 7 years. I think a target at the time was set at 25% of all US APIs being sourced locally from US. And then fast forward to the Trump administration, we have a recent resolution of the Biosecure Act. It is part of the National Defense Authorization Act. In fact, just a couple of hours ago, the lower house of Congress passed the bill with an overwhelming majority. And basically, the main outcome of this bill is that under the biotech section, it makes no mention of any Chinese provider in the section, which is different from last year's version when it named a couple of Chinese CDMOs, in particular the WuXi companies, in the bill. So that is an incremental positive. However, I would just caveat that this is an annual review process. And so next year or every year, Chinese CDMOs are still subject to these reviews and to the risk of being included again. However, this version of the bill would offer due process, so there is a legal framework for any named biotech company of concern to make an appeal. So that's one caveat. The other caveat is that there is also the military list, which is updated annually in January. And recently, there is a proposal to include WuXi AppTec onto the list. And the NDAA, or the Biosecure Act, would typically reference what's included on that military list. So given the timing, I think it could pose an additional risk to Chinese providers. Chinese CDMOs primarily make innovative drugs for Western pharmaceutical companies, and they are behind much of the development efforts throughout the drug development cycle. So by one estimate, for example, in large molecules, the WuXi group is responsible for around 10% of all the drugs being developed in the pipeline. So that's why the US has an interest to contain the rise of Chinese innovation in our space by first going after the CDMOs. So going forward, I think a major overhang has been lifted for our space with the resolution of the NDAA, and investors can now finally focus on the fundamentals of these companies. That's it from me. I'll turn it back to Crystal.
Great. Thank you so much, Lawrence. And then next up, we have the note from China Econ team, which is on the preview on China Central Economic Work Conference. Jenny, can you share what the team are expecting for CEWC?
Yeah, sure. Hi, morning, everyone. So Beijing held the December Politburo meeting this Monday, and based on past experience, then the Central Economic Work Conference will likely held by today or tomorrow. And the Politburo meeting is used to set the tone for the Central Economic Work Conference. So it shows that Beijing wants to have a solid start for the first year of 15th five-year plan. It mentioned it there, and we think it means that the GDP target next year will be maintained at a high level of 5%. But the policy approach has remained small steps and reactive. So that means they were only willing to cushion the domestic demand rather than lift it. And it's because the risk of more aggressive U.S. tariff hikes today is much less than 1 year ago after 5 rounds of the U.S.-China negotiation. And also we see the bulk of the 1 trillion RMB additional stimulus announced this fall will be carried over to early next year. So for now, policymakers don't have the high sense of urgency. And therefore, we believe the initial fiscal package size to be printed out by the Central Economic Work Conference and announced in March MPC, it could be the same as 2025, which means the official budget will be set at around 4% of GDP. The long-term central government special bond size is around 1.3 to 1.5 trillion RMB as compared to 1.3 trillion this year. And the local government special bond size will be 5 trillion RMB, and they will be only 100 billion RMB more than this year. And we think the budget rollout will be front-loaded like this year. But after the fiscal impulse fade out, and when the second quarter GDP has the pressure from the high base, we think it's possible that the year-on-year growth of the second quarter next year will fall below 5%. Then policymakers may want to add another 0.5% of GDP supplementary package by mid of next year. Then regarding to the policy mix, we think it will remain largely supply-centric, although at the margin, the Politburo meeting mentioned to expand the domestic demand and also to optimize the supply, but it did not specify any moves on service consumption, property stabilization, or social welfare support. We will need to wait for more details from the Central Economic Work Conference. And we think the pattern Beijing will maintain is that they will front-load the infrastructure push from year start, but the policy support on property market and service consumption will be reactive and slow. We may only be able to see the mortgage interest subsidy post the March MPC, and the national subsidy on service consumption may need to wait till second half of next year. And therefore, we maintained our view that the 2026 will be a year of less deflation rather than reflation. The real GDP growth can reach 4.8%, slightly lower than 5% target, but nominal growth is still weak at around 4% because of the continued deflation. Yeah, let me stop here and then hand over to Crystal. Thank you.
Thank you very much, Jenny. And then that's it on China. Now we are moving on to Korea. Recently, there has been some notable weakness in won, and then today we have Kathleen here to share her views on the impact on the economy. Over to you, Kathleen.
Hey, good morning. Hi, good morning, everyone. Thank you, Crystal. So we put out a note on the Korean won this week, as the currency has been the weakest, the most underperformer in the region in the second half of this year until last Friday. I mean, just overnight with the Fed's cutting and the recent further weakness of the yen, Korean won has come maybe in the second place, but right after yen, won has weakened more than 7.75% as of 5th of December, starting 1st of July. So this within less than 6 months, Korean won has weakened quite rapidly, and that has triggered some concerns on the potential negative effects on the economy, as well as the market flows and concerns just on the sentiment side. So we've done a deep dive on the Korean won here. So we assessed the historical impact of Korean won on the economy, most importantly on the exports front and the inflation, and how it's driven the behavior of the central bank, and how we see the BOK going forward in the backdrop of this weak currency environment. And we also touch on our outlook for next year from our FX strategist, and also the impact on the equity market, also on the KOSPI for 2026. So I'll touch on that as we go along. From the econ side, for us, the most important part is how this weak currency affects the trade flows and the inflation FX pass-through. On the trades front, especially on the exports, of course, we do have a medium-term positive coming from the weaker currency as it boosts the price competitiveness. But near term, though, in the first quarter of the rapid weakness of the won, we usually find that because of the unit price drop, the export growth tends to slow down within the first quarter, and then after 3 or 4 quarters, the volume demand picks up on the weaker unit price, and then also the improved price competitiveness. I mean, for Korea, though, historically, when we assess the FX trend and also its correlation to exports, from 2000 through 2024, we'll say the positive effect of weaker currency on export had rather weakened versus the 1990s, and also when Korea actually started to focus on the semiconductor exports. So before the semiconductor upcycle, the first super cycle that we've experienced in 2017 and 19, the benefit of weaker won was a lot larger. But after the semiconductor has become the largest portion in the exports, which isn't necessarily sensitive to the FX in terms of its volume, it's more driven by the market demand and supply dynamics. Hence, the sensitivity to FX affecting the overall export basket had narrowed down a bit. So for us going forward from here onward, I mean, the positive pass-through or the positive effects of FX, the weaker one, is likely to help the overall export growth to be resilient in the second half of 2026, benefiting from the FX effects. But overall, we do think the main driver of export recovery next year, or the resilience in export, will continue to be the story for the semiconductors, and also the non-tech exports coming from the global aggregate demand improving, not necessarily coming from the FX in the first half, but on the second half, we do think there could be benefits from this FX effect that's been rolling out in the second half of 2025. On the inflation front, we do see the negative playing the larger part than the positives here, as the FX pass-through effects onto the inflation is likely to add upward pressure on the headline inflation for Korea. So the analysis is that the 10% weakness or the 10% change in inflation leads to 20 to 30 basis points of an upward pressure on the CPI inflation on the headline within the 12 months following the rapid weakness or the weakness of the currency. And in the instance of where the weakness had even been coming from a very squeezed period of less than 2 quarters, then we could also see the upper pressure increasing even faster to 130 basis points in the following 12 to 24 months. So this was the analysis by the BOK, and we also have seen that in the historical analysis that we've also done in Korea's case, which could also pass on the headline inflation pressure of extra 30 basis points from 10% weakness in the currency. So for us, the near-term outlook, though, in 2026, we are looking at a very benign global oil price outlook, and the domestic recovery is coming around gradually. So we do think that the inflation would stay around 2.1% in 2026 for Korea. But we do think that the second half of 2027, though, this accumulated recovery in the consumption or the demand pressure, coupled with this weak currency pass-through, potentially putting upward pressure on the headline inflation. So we do think that above target or above 2% inflation, closer to mid level of 2% CPI inflation is likely in Korea, which could lead to the BOK's action to turn around to the hiking cycle in the second half of 2027. Overall, for now, I mean, BOK does seem rather, they do see a stable inflation outlook in 2026 and 7. They've just released their November forecast for their growth and inflation. And despite the fact that they do see a huge rebound in the growth side to 1.8% next year from 1.0 this year, they do see the inflation staying stable at 2.1% for 2026 and 2.0 for 2027. So in that sense, it does seem that BOK is not yet much concerned about the pass-through effects onto the inflation. But just yesterday, though, we did have a BOK MPC member, Kim, at a press conference addressing they are closely looking out for any potential implications of the FX pass-through onto the inflation from the weak currency. I mean, from our FX team's view on Korean won, though, they do see some room for recovery on the back of the Fed's rate cut and also the improving fundamentals of the Korean economy, as well as the flow picture. They do see that the current account and the capital account would stay stable. That's aligned with our view. But the equity side, we also see 15 to 30 billion of net inflow into the domestic market from the improved sentiment on the semiconductors and also the continued reform story that the Korean government is likely to push, especially until the local government election we have in June. So with this improved foreigners inflow, we do think the dollar won could, the end of second quarter, come down to 14.10. And we do think that the room for improvement does, from the fundamental side and also the external, the macro front, especially in the US dollar front, are supportive of the currency more so in 2026 and 2025. I mean, another thing we're closely watching for is, of course, the NPSs, the new framework that the Minister of Finance has been mentioning in the past week or so. I mean, we did not get any concrete details of what the changes in the pension funds hedging ratio or their funding method. For example, they did mention the possibility of dollar debt issuance to fund the dollar flows or the overseas investments for next year. So these diversified methods of dollar funding for the NPS outside of the spot market could help the room for recovery for Korean won also, which we do think will be very critical. And we are waiting for the announcement potentially early next year after the chairman of the NPS and the new CIO are finalized by then. I mean, very lastly, on the equity market, our equity strategists do see that the equity market has grown more or less sensitive to the dollar won moves historically compared to, before 2015 to in the past 10 years. But at the same time, they still, the fund flow wise, the weaker one is seen as not so positive factor for the foreign investors. But at the same time, June does see that the more important stories for KOSPI next year, rather than the currency, will be the reform story and how the bills on the current items on the legislation, including the dividend tax revisions to the capital markets, the reform measures, how those will go through will be the more main driver of the flows rather than the currency. So in that sense, we do stay rather neutral in the currency's effects on KOSPI next year. I'll pass it back to you, Crystal. Thank you.
Thank you very much, Kathleen. That's super clear. So now we are moving on to the Q&A session. And then the first question, I guess, is more for Chetan. The client is asking whether China can strengthen its currency and at the same time still keep the similar or still grow their export market share.
Well, yeah, I think we don't think that China's competitiveness is going to get affected by some modest currency appreciation. But we would sort of align the decision on currency on whether to appreciate or not more to the underlying deflationary dynamic that China is going through. Considering that it has this deflation pressure ongoing, it would be counterproductive to have a strong currency appreciation. And again, it will not lose market share, but it's more to the dynamic of if you already have deflation, currency appreciation will not help that. And we can see the live example in case of Japan. Currency depreciation has played an important role in getting Japan's inflation back up. So if China does resort to big currency appreciation, it will sort of make it more difficult for it to manage its own deflationary pressures. Back to you, Crystal.
Thanks, Chetan. There's another question on for Lawrence. So what are the CDMOs doing to mitigate the supply chain and also to decouple the risk from the multipolar world trend?
Yeah, so I think there's two ways that the U.S. can disrupt the supply chain or hurt the competitiveness of Chinese providers. One is obviously through the tariff rate. It was raised to 20% in February and March of this year, and it was tied to the fentanyl issue. So it was contingent on China doing something to crack down on the illegal flow of fentanyl. It was recently cut down to 10% in the latest series of talks between. So right now it stands at 10%. And on the tariff, there's no way to circumvent that except to absorb it in your gross margin or to share it with your importer or customer in the U.S. So it is a tax mainly borne by the U.S. customer and the importer, not the Chinese partner. But oftentimes they would share the cost of that tariff. So that's on the tax side. On the supply chain side, I think we have seen various U.S. sanctions on restricting federal funding with Chinese entities that are deemed to be either tied to the military or to be deemed working on genomic data. So those are two types of risks that the U.S. is very, very sensitive about. And what I've seen the CDMOs do is to diversify their supply chain. We're seeing a scenario where there would be a region for region manufacturing. For example, if your customer is based in the US and if they're worried about supply chain risks, they would want you to supply the final end product, what we call the formulation product in pharmaceuticals, out of a US site. And the WuXi companies have been building sites in the US and secondarily in Singapore because it is a more friendly nation relative to China to the US. At least it's not named as an adversary in the latest series of documents. And in particular, those plants that are being built, the new CapEx has been spent on the formulation side. So the final product that is subject to FDA inspections and customers oftentimes would require proximity to those sites. So in the future, I think our CDMO analysts around the world here at MS would agree that there would be a scenario where a Chinese or Asian CDMO is used for Asia, and one for Europe, and one for North America.
Great. Thank you so much, Lawrence. I don't see any other question online. And then, so in the interest of time, we'll just conclude the webcast here. Thank you so much for joining us, and do reach out to me and the team if you have any other questions. Just to note that this is the second last webcast for this year, and then we have another one for next week, and then we'll be off for Christmas and also New Year. Thank you so much, and early Merry Christmas to everyone. Have a nice day and see you next week. Thank you.